Welcome to the HMO Property Show, by investors for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host Neil Gibb, and today I want to talk to you about two very important emotions which drive every market, and then I'm going to explain to you where we are in that market right now and what emotions are driving it, and more importantly, what you can do as an investor or an educated and informed investor to make decisions right now that can help you continue to build wealth in the future as well. So, as I said, the markets are driven by two very, very powerful emotions: fear and greed. When people are fearful, they will pull back, they will hesitate, they will sit on the fence, they will squirrel money away, and they will put it into a bank account because that's where it feels safe. And when people are greedy, then they start FOMOing into markets. And for those that are not down with the kids, FOMO means fear of missing out. People will jump into investments because they think it's flying. So I can think back to when I FOMO'd into stuff. Bitcoin, when it went on that big rally in like 2014, 15, I think I jumped in there. You know, rode it up, thought it would never end, and never cashed out at the top, and then it crashed, and I literally lost just about everything that I put in there. So they're the two emotions that drive every market when you think about it, right? Whether that's real estate, whether that's share investing, whether that's investing in businesses, and whether that's investing in the crypto market as well. And right now, if you think about the property market, because of what just happened from the government announcement and the proposed changes to the negative gearing and the CGT, we are now right in the middle of a fear cycle. And nobody invests when they're confused. And that's what's happening right now. A lot of people, and I would say 95, maybe 97, 98% of the market are sitting back because they're confused, because they're frustrated, they feel like the governments have lied to them. They've invested their hard-earned money into certain assets like real estate, and now the government are moving the goalposts again. And the noise is very, very loud around this, right? There's a lot of people out there which are, again, angry and frustrated. But in essence, the fundamentals of investing in property have not moved 1 inch. What I do know is scared money will never make money. And I've got some data here to show you that when people have sat on the fence, they have missed out on certain things that have happened after big announcements in the market, right? Because all that happens is things get released, news gets released, policy gets potentially changed, or not potentially changed. They announce changes to policy, which then knocks the wind out of the market. And then sometimes them proposed changes never actually come into effect anyway. And then the market just continues on. And there's two things I am absolutely dead certain about in this country. People will always need somewhere to live, and investors will always be looking to put their money into something so that it grows for them, so that they don't have to keep working hard for money, right? The only way to build wealth in the world is to invest in shares, business, crypto, property. You need to invest. You cannot save your way to wealth. You need to invest in assets. It's as simple as that, right? So I've got some evidence to show you that there's a bit of a framework that happens, right? And it's disruption, freeze, recovery, new highs. Every single time without exception, right? It happens over and over again. It continues to repeat itself, and it will continue to repeat itself. One thing I can say to you right now is real estate in Australia the most expensive it's ever been? Yes. Is it more expensive than it was 10 years ago? Yes. And how many things have happened in them 10 years which have slowed investors down, have stopped investors from investing? But the trend of the market continues to move in the same direction, right? It corrects. Don't get me wrong. It slows down at times, or different segments of the market correct over time. But it generally trends in an upward trend, right? So in from 2000, the year 2000 in Perth, and we're going back 25 years now, to 2007, we've seen over 233% growth in Western Australia. The median house price went from around $150,000 to nearly $500,000, which is a 233% increase in 7 years. Now, the gurus and the property investors will say property generally doubles in value every 10 years. Now, Perth had a crazy run there, right? What caused it? WA mining boom created a job surge, and interstate and overseas workers flooded the state, and Western Australia just grew fast. Perth specifically, housing supply couldn't keep up. Sound familiar? It's very familiar to what's happening now, apart from we do not have a mining boom going on right now. We do not have a construction boom up north, which I'm going to dig into a little bit further. But when I came to this country, I got pulled into some of the biggest projects on the planet. Gorgon project chewed up like 35,000 people alone just in that one project. Then Chevron made a great idea to also do another mega project just a couple of k's up the road called the Wheatstone project. That again chewed up thousands and thousands of people. And then Impact started doing the Impact project as well. Across them three projects, there was nearly 100,000 people required for them. That drew people into the state, and that's where this big boom came from. Right now, I'm not aware of any mega projects that are ongoing. I am just aware that Perth is a beautiful place to live. The infrastructure's improved massively over the last 15 years that I've lived here. In fact, it's 16 years that I've lived in this beautiful state. And this is now becoming a more desired place to live. And people are cashing out of their properties that they've made money in Sydney, and they either move to Brisbane or Perth. Right, because the weather's beautiful, the housing's cheap, and people can live a really, really beautiful lifestyle here. In 2004, 2010, median house prices in Perth and Darwin doubled as a mining boom drew workers and resources from around the world. And nobody was really calling Perth the place to be, but the people that invested made a lot of wealth, right? Then you had the GFC in 2008. When it happened, every expert was predicting a 40% collapse in the property market. Every single headline was saying, sell your real estate, sell your real estate, sell your real estate. But what actually happened is every Australian capital, except Perth, went up the following year. Perth fell 1.6%. That's 38.4% less than the experts predicted, right? But because the GFC happened and because the experts were shouting from the rooftop, people were thinking, oh my God, I'm going to have to sell, I'm going to have to sell. The freeze was real, but to be honest, the fundamentals, the government pumped $50 billion in stimulus, RBA cuts rates hard, the first home buyer grant supercharged demand, supply didn't change because there was a heap of demand. The demand left the market because people were scared, like they are now. The government, bless the cotton socks, they stimulated the market with all these different stimuluses, and the demand came flying back and charged the market up, right? One thing I do know is the government do not want to crash the property market. And the reason why is a lot of these politicians all own real estate themselves, right? So they'd be stupid to bring out a policy that is going to reduce their wealth. And a lot of these politicians are older now as well, right? They've been in the game a while. They've been earning good money. They've been using negative gearing to offset the tax but build wealth at the same time. So none of these guys want to retire and have less money to retire on than they've got now. So it'd be interesting to see if these proposed changes actually get passed through the Senate and get legislated, because I think there's going to be some pushback. I've got some more details on that in this exact episode. So another thing that happened in 2013 to 2017, we had the East Coast boom. And what caused it? We had record low interest rates, strong investor demand, and strong population growth. Supply was nowhere near keeping up with demand in Sydney and Melbourne. Prices increased by around 20% a year in Sydney and Melbourne in 2013 and 2014. The people who froze after the 2011 to the 2012 dip and waited for certainty missed one of the biggest booms in Australian history. Let me just rephrase some of that again. Record low interest rates. We don't have them now, but they are still low in comparison to 15, 16, 17%. Strong investor demand. Yep, we've definitely got that. Why have we got strong investor demand? Because we've got strong population growth. Why have we got strong population growth? Because everyone wants to move to this beautiful country. Do we have enough housing for these people? No. So we've got strong investor demand to build more housing for these people. All that's happening is there's a little bit of uncertainty in the market right now. The market is going to correct. if these rules do get passed through the Senate, they are just going to become the new norm. I was talking to somebody the other day and I said, it's like going to the petrol station. When you first see the petrol prices, when I first got to this country, I was paying 89 cents a litre. It might be 90 cents a litre, but what's a cent? And I've seen them go up to 150, 160, and then all of a sudden it goes to 250, and I'm filling my car up the day. It cost me $180. And when I first filled it up 3 months ago and it was $180, I was like, God, I can't believe it's $180. Now I'm just like, it's $180. It just becomes the new norm. The government will move the goalpost, and the people that can adapt to the new position of the goalpost are the ones that are going to make more wealth and are going to get into the market, stay in the market, and then when everybody else gets comfortable, it's going to push up the people that are already in that market. What I'm trying to say is, I'm not holding back. I'm not stopping. I'm looking for opportunities right now in this market, and I know where there is opportunity. You can see it a mile off. We've talked about it a lot in manufactured growth strategies, subdivision, duplexes, stratas. Adding value, forcing value through development into property is the game. It's always been the game. It's always been the way to do it. And if you can't, or you don't have the skill set to do a development like that, then buy an asset that you can at least reduce the debt on, so that you are still building wealth, even if the market does not go up in value, because you're using your cash flow to reduce your debt position and you're still building wealth. So they're the two games that you need to play. If you're just relying on market growth, yes, that's good. Don't get me wrong. Capital growth is a winner. We need it to leverage into other properties. But we can also leverage into other properties by reducing our debt position, because that's the same as the market going up. Your debt's going down. Either way, you're building equity. So you can either do it through manufactured growth strategies, forcing value, or you can do it where your cash flow just reduces your debt position. Right, one of the other things that happened 2017, 2019, we had the APRA crackdown. And it was Sydney went down 14 to 15% from the peak to the trough. Melbourne went down 10 to 11%. Brisbane went up. Adelaide went up. And what happened is APRA capped investor lending and interest-only loans. And there was credit restrictions. So it wasn't an economic collapse. It wasn't a demand problem. Literally APRA just putting the handbrake on and saying, too many investors in the market. We're going to slow this down. The fundamentals are population growth, housing under supply, them never changed. The correction was regulation, not structural. And when APRA eased the market, the market went straight back up. And this is exactly what you're going to see right now, right? When these changes if they do get passed, then the market's going to go up. And if they don't get passed, the market's going to go up again. So the people that are sitting on the fence, you're going to get splinters in your bum. I say it all the time. The market does not stop for anybody, right? The right markets as well, the right asset in the right market. And I'm doing market cycles there. 2019, we had the federal election. Bill Shorten and Labour proposed negative gearing removal on existing properties, and they were going to halve capital gains tax as well from 50 down to 25%. Everybody froze. The market went quiet. Newspaper headlines are saying the market is finished, doom prediction. And Morrison won in what he himself called a miracle. Every poll had Labour winning, and after losing on the same policy in 2016 and 2019, Labour then formally dumped it before 2022. Then they ruled it out again in 2025. They won again, then they did it anyway throughout the budget. So the market froze over a policy that was never passed, and this is the definition of scared money, right? This is just uncertainty in the market, and people will never invest in a state of confusion. All they want right now is to understand what the new rules are, then they'll invest again. But why not just invest now and just adapt to the new rules? It's as simple as that, isn't it? If you're following the fundamentals of what a good investment is, it doesn't matter what the rules are, really, does it? Does it? If you're paying a little bit more tax when you sell, it is what it is. It should not stop you from investing, because you can still make more money by investing and pay more tax in the back end. Then you could just keep your money in a bank account and hoping and praying that someday you are going to be wealthy enough to retire. Obviously, we had COVID in March 2020, like global pandemic, economy shut, borders closed. We had a little 1.7% dip. Then we had the largest property boom in Australian history. 53% national growth in under 2 years. Perth's still going off the back of it. What caused it? Ultra low rates, government stimulus, people moving back into Australia, especially Perth, one of the safest, most isolated cities on earth. Demand surged, supply couldn't respond, and fundamentals don't stop for a virus. Right? Everybody got a cold, but everybody still needed somewhere to live, and we just kept going. Then we had 2022, we've had 13 rate hikes, right? The most aggressive tightening since 1994, and everybody was saying that the market was going to crash with predictions of 20 to 25%. Actual correction was 8.4%, then full recovery within 18 months. New national highs above pre-hike levels. Again, people would have sat back, people would have tried to stop. Again, when the interest rates go up, yes, people get frustrated, people get aggravated, people get angry, but they've still got money. Everyone's sat on equity right now. Everybody wants to deploy their equity into more investments that continue to build their wealth, whether that's principal place of residence equity or whether they've got a property portfolio that's got equity in it. People will still want to build that wealth. They want to manage and multiply that money by investing in more housing. And now, right now, in 2025-26, we've got the negative gearing and capital gains tax changes announced. Right now, investors are froze, contracts being cancelled, people are sitting back, people are saying that the borrowing capacity is being reduced because the banks have now factored in or removed the negative gearing calculation from their borrowing capacity calculations, which has reduced people's serviceability. And Perth median house price is currently $1,097,000, which is up 25.6% in the last year alone. And right now, Perth is the fastest growing city right across the state. Yet again, Melbourne and Sydney are dipping. Perth continue to grow. Why? Tools, supply and demand. Very, very basic. We're getting more rental properties on the market. I think we're up around 2,400, 2,500 according to REWA. That's well below the 8,000 that we need for a balanced market. But let's just think about this balanced market statistic that's been out there for a while, right? REWA say that a balanced market's between 8,000 and 10,000 rental properties. But that was when the population was 2.1%. 2.1 million. Now we've got over 3 million people living in this state. That means we've got more housing availability because we've been building more houses over the years. So surely that balanced market figure must shift from 8 to 10,000 to 10 to 12,000, which means we're actually in a bigger deficit now because we've still got the same amount of properties for rent on the market that we've had for the last 3 to 4 years. Let me just tell you a little bit about the Perth story. So I started investing in 2014. And that was the kind of bottom of the post-mining correction. And the first deal I did, I sold it kind of at the peak. And I kind of watched what we proposed to make and what we did make was about 30k difference, right? We just slashed the price, got it moved. Still walked away from that deal with 40 odd K profit. And it took us 26 days from start to finish to do it. And we did a joint venture with the seller. So we didn't buy the property, we didn't pay stamp duty. We agreed to pay them a certain price, but we also agreed to pay them that price at the back end once we forced value on the property through renovation and we sold it through a real estate agent. They got their money, we kept the difference in the transaction, which was $40,000. Everybody was a winner because they got a little bit more money than what they wanted. What we would have paid in stamp duty, we give them that and said, well, you give them that. Then we didn't have any holding costs because we didn't buy the property. So it was just a win-win. We didn't have to put large sums of money down in terms of 20% deposits. We just paid for the renovation, which we did the majority of it ourselves and we made some really good money. And what happened with the last Perth downturn? Because people always say, yeah, but Perth had a massive downturn and Perth's a mining town. Let's just go back to 2014, right? That's when I got pulled into oil and gas. 2012, 2013, I would have said. I got onto the Gorgon project, which was one of, if not the biggest project on the planet, and chewed up thousands and thousands of people. Then we had Wheatstone project that I transitioned from Gorgon. I went to Papua New Guinea for a little while and worked on the PNG LNG project. And then I came back from Papua New Guinea, and I went to Wheatstone and I worked on the Wheatstone offshore project for 2 years. We also had Gina Reinhardt, which was doing the Roy Hill expansion. We had BHP doing some of their expansions. We had Woodside doing some of their expansions. So some of the largest construction projects in the world all happened at the same time, which drew hundreds of thousands of people to Western Australia, which was kind of like an artificial boom, if you think about it, because as soon as them projects finished, everybody left and started chasing the work again. This cycle is totally different. There's no big projects on the go right now. Mining is just ongoing, right? They've expanded all the projects. They're just producing iron ore. They're just exporting it now. It's as simple as that. So it's kind of organic population growth. People are actively choosing Perth for lifestyle and affordability, not for the industry and not for projects that are just going to be in and out. And by 2020, even though we started investing in 2014, 2015, we started our property management business in 2017, and by 2020, we'd done over 80 properties, 80 HMOs, and we'd done all them in a downward market. And a lot of them clients brought us properties that they couldn't sell because they were in negative equity, and we convert them from a negative equity, negative cash flow position to a negative equity, positive cash flow position. So all of a sudden, it wasn't hurting them to hold them properties. Them clients have still got them properties, so they held through the downturn because they were getting positive cash flow. They didn't have to stress about losing money and not being able to afford to hold these properties. And they rode it through the next big boom, positive cash flow all the way through to the point now where them properties have doubled in value again, still cash flow positive. So the beauty of these HMO, as we've always said, right, you can pay down debt. And this is what scared money never understands, right? Because they look at this and they go, it's cash flow positive, it's principal and interest, you build wealth in every market condition, up, down, or completely flat. And the reason that you're building wealth in every position is because you're paying down debt. If the market goes up and you're paying down debt, you're building wealth twice as fast. If the market stays horizontal and you pay down debt, then you're still building wealth, right? It's not as fast as if the market's going up, but at least you're not losing money, you're not bleeding money, right? So if we look at real numbers, let's say you got a $1.1 million property, you got an $800K mortgage on it, let's say it's a HMO. Principal interest repayments at current rates are approximately 58 grand a year. Of that, around $10,000 is principal reduction, and that number grows every single year as the interest component falls. So if your property is cash flow positive 25 grand a year on top of that 10K principal component, then you're essentially paying down $35,000 of debt, which means you've increased your wealth by $35,000. Now, if the market on a $1 million property drops 3 to 4%, that's $30,000 to $40,000 paper loss. You don't lose until you sell, right? Your actually wealth position is up $35,000 real because you've reduced debt and you've got equity, but you've lost $30,000 to $40,000 on paper, but your debt position's still reducing, right? So you're still ahead and you're still moving forward, because the minute that the market moves, all of a sudden it moves off that debt position and then you start building wealth very, very fast. Now, scared money that's sitting in a bank account with inflation running at 3 to 4%, that chews through buying power every single year. You're just going to lose in terms of not investing on anything because you need to make your money work hard for you. Property is one of the few asset classes that is genuinely pegged to inflation over time, because when there's more money in the system, that means they're earning more money and they can invest in more assets, and the assets that they generally invest in are real estate. And because they've got more money, it means they can pay more, which it generally inflates the price of real estate. It's very, very simple. It happens over and over again. Your money in the bank does the absolute opposite. It's going down in value every time real estate's going up in value, because $100,000 now is not the same as $100,000 10 years ago. And $100,000 now will not be the same as it will be in 10 years' time. Think about your Coles shopping trip or your Woolies shopping trip. Like, how much has that increased in value over time? It's probably doubled in value, right? But your $100,000 is still $100,000. But your Coles shop has gone from $200 to $400, and you're still earning $100,000, right? Real estate increases in value in line with inflation. And if you've got real estate that's going up in value, that's producing cash flow at the same time, so you can reduce your debt, then absolutely laughing, aren't you? Now, some of the things that I've heard people say over the last few weeks as well is, I'm just, because if people say, look, I'm just going to wait until we find out till we know what's going on. Or some people have just said, you know what, I'm over it. I'm not going to invest. I'm just going to pay down my principal place of residence, and then I'm just going to put the rest of my money into super. Like, before you do either of them, look at the generation ahead of you, right? So the people who did everything right by the traditional playbook, and I want you to look at people in your life now that are in their 60s or 70s, right? They pay down their principal place of residence, and they probably only paid $100,000 for it. Let's be honest, it's probably worth $900 to $1 million now. They paid down the mortgage, contributed to superannuation when that became a thing in the 90s. I just want you to look at them and their lifestyle right now and say, are they living the lifestyle that I want to live when I'm their age? Are they traveling? Are they going on holiday twice a year? Are they eating in nice restaurants? Do they have nice cars? Or are they watching every single dollar that they spend because all of their wealth is tied up in their principal place of residence? They're wealthy on paper, right? They're equity rich and cash flow poor, but you cannot spend your equity at Coles or Woolworths to buy your groceries unless you either liquidate that property and cash out and sell it to somebody else. Then you've got a lump sum of cash, but every time you spend that cash, it just goes down and down and down. And $800,000 becomes 700, 700 becomes 600, 600 becomes 500, and all of a sudden you're hurtling towards the end of your life and your money's depleting every single day. Who's me? So you got to ask yourself, right, is that the retirement that you want? And I did a podcast not too long ago. It was probably, I say not too long ago, I think we've done close to 200 episodes now, so it probably was a long time ago. But I did one on, I read Steve McKnight's book called Money Magnet, and he spoke about ASFA, which is the Association of Superannuation Funds Australia. And ASFA say that a single person needs $630,000 at retirement for a single person and $730,000 for a couple at retirement just to be comfortable. And their definition of comfortable meant eating dinner out once a fortnight, one international holiday every 2 years, and one domestic holiday once a year. That to me is not comfortable. We have not worked our asses off all of our lives to only go out once a fortnight, and then we just get to sit in the house and do nothing every night and just sit there watching TV. Life is for living. There's so many cool things that you can do in this world. Jump in an airplane, go sample a different culture and live in a different area and do some cool things. Instead of just working your ass off and then just sitting in your house and just having to watch every single penny that you're spending or every single dollar that you're spending. Because only 30% of retirement age Australians right now have even enough super to hit their definition of comfortable. 70% of people are not in that comfortable bracket, so they've got principal place of residence, or they might have property, and a lot of them might not even have property, right? And they've got very low super balances, and these people are like at retirement or have already retired right now. And the reason for that is super only started, or the contributions for super were 3% in 1992, and they've only just hit 12% in July 2025. So if you're in your 20s, 30s or 40s now, you're in a much better position than the people that have already retired, because your employers are contributing more money into your superannuation. And the system is designed to supplement the pension, not to replace the income. So anyone that worked through the 90s and 2000s would contribute in a fraction of what's actually needed. Women actually retire with roughly a third less than men, and that can potentially be down to career breaks from, having children, raising families, just being on lower wages, doing part-time work. Again, it might be because they have to base their work around the kids and the family. And government, if you think about it, why do the government keep saying, let's get the employer to put more and more money into super? They've already talked about changing the rules. Well, they don't talk about it. They've already changed the rules constantly, right? Constantly. And now there's trillions of dollars sat in the superannuation system. And I can guarantee you they have got their eyes on that. Why are they getting more and more money put in there? They're going to tap into it sooner or later. They're going to change the rules. Absolutely guaranteed. They will change the rules on superannuation. So if your plan now is to pay down your principal place of residence and put your money into super, I guarantee you will not have enough money to retire on when you retire. You need to invest in anything. Even if it's not property, find some shares. Just please invest in something, because I do not want to see these numbers get worse and worse and worse for people retiring with not enough money and having too much life left at the end of their money. That is going to be absolutely drastic. And we already spoke about the fact that you're going to have to sell your property to free up the equity that you've got inside your principal place of residence. Because when you're retired and you've got no job, the bank aren't going to lend you money to refinance cash out of that deal. So you're going to have to sell it. And then when you sell it, you're going to have to move somewhere else, and you're going to have to rent, or you're going to have to buy somewhere. So let's say you make $800,000, $900,000 from selling your principal place of residence. Are you going to rent at 40, 50 grand a year? And then you've got to live on top of that, which is going to cost you another 50, 60 grand a year in cash flow for drinks and nights out and experiences. It's almost 100 grand a year gone, and you've got 700 grand, 7 years. The average retirement age, the average rate of death, or the average age that people die in Australia, is in their 80s. So if you retire at 65 and you've got $700,000 and you spend 100 grand a year on rent and food, then you're going to run out of money at 72, and then you've got another 10 years to live, and you're going to have no cash. This is why you need investments that produce cash flow, so you can live off the cash flow. Wealth stays there. The asset is the thing that you need, and the asset needs to produce the cash flow so you can live off the cash flow. Clear as day, right, when you think about it, but people just focus so much on investing in high growth negative geared properties. They've got a place, don't get me wrong, you need to build wealth, but you can also build wealth by learning manufactured growth strategies. And if you want to learn more about them, the Cashflow Academy, we've just re-released it again. We've changed the platform because people said they didn't like the platform. The beta testers give me lots and lots of feedback on what we could do to improve it. And I'm taking all of that on board. Next month, this is June, in July, we're going to release new modules around subdivision, around new build construction, and about renovating for profit. So not specifically renovating HMOs, just how to find and renovate properties so that you can build up your equity base and then transfer that equity into cash flow producing assets. That's the game, right? Make the money, transfer it into assets. Whether that's business, if you're a business owner and you are spending all your profits, please stop. Please start moving some of that profit into assets. Like build another semi-automated business which runs 95% without you, because you've got a team there that builds it all up and manages your asset for you and just drops the cash flow into your bank account, and then you can use that cash flow to pay down the debt, so that when you sell your business in the future, you've also got a debt-free property portfolio that's producing cash flow for you to continue to live the life that you've been accustomed to while you've been a business owner, earning $5, $6, $7 million a year net after all expenses. Right on. Got a little bit sidetracked there. Where's my notes gone? Let's just wrap it up by saying this, right? The rules change constantly. The government will always change. Go, whether it's negative gearing or whether it's capital gains tax or whether it's distribution from discretionary trusts. Yes, it's frustrating. Yes, it gives you the shits. But the fundamentals never change. The game never changes. You need to find either undervalued assets, add value through renovation, subdivision, development, or buy assets that generate enough cash flow to be positive cash flow, and pay down the debt whilst you are still working. If you're investing to make 15, 20 grand a year, it's not going to make a massive change to your lifestyle. Yes, you might get a holiday out of it, it might pay the lease from a car, but if you use that $15,000 to $20,000 a year to pay down the debt on an asset, you're going to reduce that loan term from 30 years down to 15. You're going to save $250,000 in holding costs to the bank, and then you're going to have an asset that's debt free. And once you eliminate the holding cost, your cash flow increases substantially, because now you don't have to allocate a lot of your cash flow to paying down the debt, because you've already done it. And at that stage, that's when you should be transitioning from full-time employment to retirement, because you've got some assets that are debt-free and are producing income for you. Right, so finishing off, here's a question no one's asking right now. Do you move while others are frozen, or do you wait? Hopefully I've given you enough context in this podcast today to show you that the people who waited after the GFC missed the boom. The people who waited after the 2019 missed the COVID surge. The people who waited after 13 rate hikes missed the recovery to new highs. Right now, the Senate hasn't even passed legislation. It could get blocked, and if it does, the market that's been sitting frozen will just pop. It'll pop hard, it'll pop fast. And the people who move quietly, the people that are in there now, the people that continue to invest now, they're the ones that are going to get the uplift. And the people that wait are going to get caught in the stampede. And the market is still pretty hot right now, right? Pretty hot. Perth's gone from white hot to just red hot. because we've been seeing like so much demand in the Perth market now, people are saying the market's starting to soften. And I'm like, it is starting to soften, thankfully, because it's been horrible to buy in for the last 2 years because it's been so hot. We're still seeing 6 people coming to home opens, and we're still seeing 3 to 4 offers on every home open. We're just not seeing the 20, 30, 40, 50 people that we were seeing previously. A lot of that was interstate demand that was driving. Now we're seeing Perth-based people trying to buy properties themselves, whether they're investment properties, whether they're first home buyers, or whether they're owner-occupiers. They are trying to buy properties right now. Ask yourself this honestly. Has anything about the fundamental demand for housing changed? Has it? People still need shelter. We're still undersupplied by tens and thousands of properties, and population is still growing. Rents are still rising. None of that has changed because of the budget announcement. None of it. Absolutely none of it. Doing nothing is still a decision, but it's got a cost associated to it, right? If I didn't start my business, if I didn't start investing in 2014 and 2015, I wouldn't be sat here now doing what I'm doing. If I didn't set my business up in 2017, I wouldn't be sat here now doing what I'm doing. If the people that seen the value in what we could achieve for them by helping them change their negatively geared properties into cash flow positive properties, and now we've built up and brought over 1,000 rooms to the market because of that. And let's be honest, a lot of them rooms were brought to the market in the downturn. We've only been in a 2-year upswing in Perth, right? So this strategy, or any strategy, the fundamentals of property work in any market, up or down, right? Whether you're forcing value in it or whether you're producing a debt reducing asset because your cash flow is so high, them things are still needed in any market. So if you want to understand more of the rules of the game, right, like I said earlier, all this is in the Cashflow Academy. It's cheap. It's the same price at the beta testers for the month of June. It's $3,995. There's payment plans available even if you can't afford or you don't want to spend the full $3,995. Payment plans available just so you can get in there. You've got a money back guarantee. If you go back through the majority of the course and you think it's crap, just message me and say, Neil, this is crap. And we can see you've got to go through the course. You can't just come in, take the bits out that you want and then say, Neil, this is crap. I've got to see you go through the course and we can track that in the system that we've got. And if you do, here's something that nobody else will say, right? If you would do a deal in the 12 month that you join the course and you make profit from it, I will give you your money back for the course. Nobody else will do that, right? I just want to see you win. I want to see you win. So here's the deal. You pay for the course, you go through the modules, you go out there, you take action. We do a video together so you can talk about what the course has done and what you learned and the money that you made. And I'll give you your money back for the course. There you go. Nobody else will do that, right? So I'll put the link in the show notes for that as well. But let me just finish on this. The goalposts have moved. The goalposts will move again in the future. And they will move again in the future. I think the next goalposts that are going to move are going to be around superannuation, personally. And hopefully some of these changes don't come in. Either way, I don't particularly mind. Because if you're doing manufactured growth strategies anyway, then you're not really holding property, so it doesn't matter about negative gearing, and also it doesn't matter about capital gains tax because you don't pay that if you're just doing a manufactured growth strategy that you're holding short term. The question is, are you going to freeze every time the goalposts move, or are you going to learn the new rules and adapt to the new way of doing things? Because there's still money to be made. You can still build wealth through these uncertain times in real estate markets by just learning the new rules and implementing them. So learn the work, trust the process, make your money work hard for you. I'm Neil Gibb and I'll see you on the next one.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.